Welcome to Financial Accounting FRK 321. We're looking at group statements. This will be the first of two lectures on change in degree of control, or also called change in degree of ownership. Please note that this recording carries copyright. Please have your handout in front of you. You will find hand-ups and click-up if you do not have your handout available yet. Change in degree of ownership, Lecture 1. This lecture will feature more on the theory, the first part, and the second part will be on the class example. Outcomes and assessment criteria. Please take a look at your assessment criteria. It is laid out in your handouts, and the specific outcome. You should be able to account for all aspects relating to change in degree of control when preparing group financial statements. Now we are going to look at the acquisition of additional interest in an investment, which is then becomes an associate or a subsidiary, an additional interest in an associate, which becomes a subsidiary, or an additional interest in an already existing subsidiary, which then stays a subsidiary. In previous lectures, we looked at the single purchase of an interest where the initial investment immediately became a subsidiary. So what happened there is you will have zero interest in the company, and then at one point you will buy an interest in the company, and this company will immediately become a subsidiary. But we can also have the situation where we further investigate the purchase of additional interest where the previous interest was held. For example, you will have held an interest in an investment, and now you purchase a further interest and it now becomes a subsidiary, or you have an interest in an associate, you do equity accounting, and now you purchase an additional interest in the associate, which now becomes a subsidiary. The different types or methods of piecemeal acquisition, as you can see there, you can go through the list. Subsidiary stays a subsidiary, associate becomes a subsidiary, investment becomes a subsidiary, etc. A very, very important item to remember. Goodwill and gain on bargain purchase is only calculated once, and that is when control is initially acquired and not again afterwards. So once you purchase a company and that company becomes a subsidiary, at that stage you will calculate the goodwill or gain on bargain purchase. And that is the only time that you will recognize it. Any other changes in degree of control at a later stage will not carry goodwill or gain on bargain purchase, but will be transactions, equity transactions between owners of those companies. Now, what to do when this interest increases? We're first going to look at a subsidiary that stays a subsidiary. Now, changes in the parent's ownership interest in a subsidiary that do not result in a loss of control are accounted for as equity transactions. Those are transactions between owners in their capacity as owners. And remember, in this instance, non-controlling interest is also owners. They are outside shareholders of the subsidiary. Well, we'll have a look at the parent, which now has an interest in a subsidiary. Now, the initial interest in the subsidiary was 60%. So on 31 December 20.8, they purchased another 15%, and now they have a 75% interest in the subsidiary. Now, from whom does the parent buy that additional interest of 15%? Yes, as we previously said, from the non-controlling interest, the outside shareholders. Now, how will this happen? Or how are we going to calculate what we have purchased? You calculate the equity, the reserves, and the retained earnings that is attributable to this additional interest that you're going to purchase on the date of acquisition of that additional interest. And we will call that the further interest. The carrying amounts of the controlling and the non-controlling interest shall now be adjusted with this further interest to reflect the changes in the relative interest in the subsidiary. That means that we will take from the non-controlling interest, because that is where we purchase our additional interest, we will take that minus it from the non-controlling interest, and add it to the parent's investment in this subsidiary. Now we must also calculate a profit or loss that we made. So we compare this further interest that we have now received with the consideration that we paid, the amount that we paid for these additional shares. And the difference between these two calculations is then recognized in equity as retained earnings, directly to retained earnings. Now let us have a look at class example number 1.